Good morning. Welcome back to ONV's A Financial Pillar. I'm your host, Ryan Lepird. And joining me on the set today, we got our co-hosts, normal panel, JJ.
I'm JJ Foster from Lake City Bank. It's good to be back. Good to have you back, Ryan.
Man, it's great to be back. Feels like it's been forever since I've been with you guys. So it's great to be back. BT?
All right. Hi. Yeah, my name is Terrence. From PNC Bank. Little disclaimer: all thoughts and opinions are of my own origin and descent, and no way, shape, or form represent my employer.
Great. And then we have a special guest for you today, Chris Sommers with PNC Bank as well. Chris, tell the audience a little bit about yourself.
Yeah, certainly. I appreciate you guys having me on today. Been with PNC Bank for about 10 years. Started on the consumer side for about the first five. Last five, I spent primary focus on business banking. I also run the branch. Also, disclaimer, any thoughts and opinions I share today are my own.
Awesome. Well, it's great to have you. Thanks for joining us today, Chris.
Thank you.
So today our topic is going to be over lending, okay? More specifically, probably consumer lending, right? Last episode, a few weeks ago, the two of you gentlemen were talking a little bit about credit, which I think is a great transition into that lending. And Terrence, listening back to the episode, because I wasn't a part of that, but you had made a comment about credit being your golden ticket to happiness. Do you remember that comment?
Yes, I do remember that comment. I do stand by that firmly. I will die on that hill that credit is the ticket to a better life.
You want to elaborate on that, why you say that?
Of course. So just to continue on from our previous conversation with credit, of course, having a strong credit score is going to be your ticket to a better life. Of course, when it comes to lending, getting auto loans, home mortgages, even personal loans, things like that, having a great credit score is that ticket to a better life. And segueing into the lending portion of that, I like to start off a little bit with that. The stronger your credit score, the easier lending will be for you. And we can elaborate on that as we keep going.
Absolutely. And, on the reverse of that, the worse your credit is, the more costly it can be for you.
Exactly.
Right? So let's just jump in with basic lending, talking about the difference between secured and unsecured, right? So give me some examples, Chris, of what an unsecured loan would be. What does that mean?
Yeah, unsecured lending. Anytime you're looking at that, it's got no backing. So you're taking out a loan. There's nothing essentially covering that loan.
No collateral.
No
right?
collateral, exactly. So you're not putting a house or a car against it. You're essentially just the bank's giving you money and essentially, trusting that you're going to be able to make the payments back, but there's nothing that's going to protect the bank, and essentially, if you don't pay that.
And when the bank's determining on whether they're going to give you that loan or not, what are they looking at? What's the basis for their decision on whether you would get that loan?
Big part of it's going to be your credit score.
Credit, right?
Yep.
Specifically around like personal loans, because there is no collateral, right? So
Exactly.
the whole loan's basis is your credit worthiness based upon the credit history that you've established.
Exactly.
Right. Do we have some examples of unsecured loans?
We do, but even before not to go around your question, we're talking basic lending. You always got to remember the four C's.
What's that?
Credit is what I'm talking about, your ability to pay the bills or your debt, capacity. Do you have the capacity to pay them future and long term, or present and long term, the capital, your liabilities and your assets, and then collateral, like you said, based off of what type of loan. So those are the things that when I talk to people, that's what you really have to look at when you're talking about getting money lent to you.
Very good. Very good. So Terrence, what are some examples that you see of unsecured?
The number one that a lot of people either tend to struggle with or are firmly against, and that would be credit cards.
Credit cards?
Credit cards are definitely unsecured. There is nothing backing a credit card, so if you decide you want to rack up all that debt, at least they're not going to take your house or your car over that. That doesn't mean you still rack up the credit card debt, of course, but it is something that does not come attached with collateral. Just like Chris said, as well, going to piggyback off that with some personal loans out there, of course. Now, to segue into the secured loans, of course, that's when we start talking about mortgages. Houses would be the collateral. Auto loans, the cars would be the collateral in that case as well.
Yeah. Not a few other examples of secured loans, recreational vehicle loans, home equity line of credits, which the collateral is the home. We got the mortgages we talked about, which JJ is a specialist in that department, right?
Right.
Yep. But so understanding the difference there when you go to apply for the loan and understanding whether you have collateral or not, right? Because there's times where you could go and want just a personal loan, but when we understand a secured versus unsecured loan, typically an unsecured loan is going to be at a higher cost, right? Because there is no collateral. It's riskier to a bank. Therefore, you're probably going to pay a higher rate for that loan. Whereas if you have collateral, when it comes to a home or a car or something like that, you're going to get a lower rate because of the event of a default. There's something the bank can come to recoup the loan, right? So within understanding that, if you go to apply for the loan, right, and understanding what you want and what you want to ask for is all you know is you need a personal loan. But do you have like an automobile that's paid off? Right? Could you use that as collateral to maybe get a better loan? And that's where having a banker like the two of you gentlemen come into play, where you can kind of help recommend that type of things to clients, right? So what kind of conversations are you having with clients around loans?
Chris, I'll let you go ahead and take that one.
I mean, essentially, usually I kind of start, when I'm having a conversation with a client, when they're looking at any type of lending is, obviously first questions get out, out of my mouth is always, kind of where do you know where your credit score lies? The other biggest thing is, I always, let my clients know not to overextend yourself, because the bank is always going to approve you based off of, the income you got coming in, what your credit score looks like, but they're not factoring in all of the other daily things that it comes into play in your life on a monthly basis, so you got to, make sure that you're not overextending yourself when it comes to that. Because even though you can get approved for a loan, doesn't mean that you have the financial capacity, like he was talking about, to be able to actually pay that loan back, because you're not factoring in all the other stuff that comes into play.
That is a great point that I'd like to jump into a little bit more on that. So when you say the capacity to pay back the loan, right, we call that like the debt ratio. That's what the bank's factoring in. But when the bank's factoring that in, there's things that they're not accounting for within that you need to, because those are still things. What are some examples of that?
I mean, they're not thinking about the groceries that you gotta, pay. I mean, if you got a bunch of kids, they're not factoring in all the expenses that come into play with that, kids in sports, things like that. So you have to think those things through. So, I always let my clients know, especially, if I, get them, early on is, let's create a budget so we can get a full picture of exactly what, you're doing on a, daily, weekly, monthly basis. And then we can actually get an idea of what you can actually look for, if you're looking for a personal loan or a mortgage, how much can you afford monthly, things like that. So.
Okay. And then JJ, go ahead.
I was going to say, with that in mind, while we're talking, collateral, let's talk about, you're putting something up. If you don't have that ability to pay that loan, what is the result?
Are you talking about if you're backing it with collateral?
Correct.
So, I mean, in those situations, if you're backing a loan with collateral, essentially they can take that collateral, whether that's a home, whether that's a car, whatever it may be, backing that. We hadn't offered it in quite some time, but there's even some banks out there that will allow you to put money up against like a loan, like an investment account you can have, as collateral for a secured loan.
Brokered secured
so
loan.
They can, take those funds then if you're not going to pay back the loan. So there's a lot of things that.
So essentially, whenever you're getting a loan that's based upon the collateral, if you don't pay the loan, then in turn the bank or the lender can come and recoup that
Exactly.
by taking the collateral back, right?
And then not only that, but then that's still going to be a black mark on your credit. So just because
they took it doesn't mean that you're off scot-free and your credit's just fine, right?
Exactly.
You had the late payments to get to that point, and that's a negative. But I can say from working from a bank, a lot of people's misconceptions are like, oh, well, the bank can take this anytime. It's fine. Why do they care? A bank does not give out a loan with the intentions of wanting to take that back. It costs them money to do so. That's never the intent of the bank. That's just what they're doing to secure it, to recoup some of the funds. They're not, in most cases, they're not going to recoup 100% of the funds that they gave you by that collateral, right? Exactly. So it's not their intent. But a term that we've been mentioning a few times already, mortgage. I know when I was, early 20s, fresh out of high school, getting new to all this, I heard the term mortgage, but I had no idea what that meant. JJ, what is a mortgage?
A mortgage is the money that you borrow from a bank. You're going to finance the cost of your home. So
it's a home loan.
Correct.
Yep.
Correct.
Yep.
Yeah, and there's different type of mortgages that are out there too. That's to your point. There's a conventional. There's a FHA, USDA. There's a variety of different loans that are out there. And as we talked about all the time, go around, shop, find out what loan best suits you, whether it's a mortgage loan or even, personal loans that we're talking about.
Yep. And I think to touch a little bit more on what Chris mentioned about knowing your own budget is key, especially when it comes to a mortgage, because a lot of times people, they'll just go and look for a home and they'll rely on the lender to say, okay, well, based upon the income documentations and everything you've presented to me, you fall into this range monthly price wise, right? But there's things that they're not taking into consideration, which is groceries, childcare, right? Insurance, things like that are costs that you're going to need to have, but don't necessarily fall into a bank's underwriting requirements when determining on how much you can afford for the loan.
Yeah, and a lot of times, I mean, banks, I know we have, in place, our magic number is 42%, that debt to income ratio, where you try to take into consideration just what you're talking about, emergencies that pop up. People don't understand, especially when you have kids. You have no control over something that's going to pop up. A kid has a play, they have, sporting events, somebody gets hurt. These are all things that that money comes out of your pocket. And are you going to have that ability to pay that mortgage for that month?
Or to add to that, having a kid, right? You didn't plan on having the kid, or you didn't plan on having another kid, but you're in a house now. All of a sudden, now I'm strapped, right? What am I going to do? So making sure, even though the bank require, their underwriting guidelines are you can't be over 42%, they're still not factoring in the necessities and the unknown that could take effect later. So do you want to max yourself out and then, be in a bad situation, or do you want to say, okay, I qualify for this, but let me look at something in this price range? Right, so there's a lot of factors that go into it.
Yeah, and I think we touched on that in other episodes too, where we talked about you don't want to put yourself in a position where, yeah, I think I can pay this mortgage. I could pay it for 6 months, and then I know after a certain amount of months, maybe I can't. You want to be in a situation where you're comfortable. You can make that payment.
Yep. Yeah, and I feel like you always want to leave some room, a gap of, this is where I think I can afford, but I still don't want to get to that figure, because and I feel like last couple of years, a lot of people have found themselves in a situation, they strap themselves, they're like, I can afford this. And then everything skyrocketed prices.
Oh yeah.
And so now they find themselves in I could afford this 2 years ago. Now I've got a loan. I can't afford this anymore because they, took themselves to that 42%, debt to income ratio. And they're like, oh, well, I'm still in line, but then now everything's gone up and now that's no longer the case.
Yeah. And in today's environment now, like if that was the case, you can't afford the current house you're in. So you think the solution is, well, I'll sell my house and get another one. But with as high as interest rates are now, you're actually going to get a lesser house for the same price. Right. It's different times. So
I'm in exactly the same situation personally. So.
Yeah. Some people have they own their home. They're like, oh, this is a great time to sell because I can get a lot of money for it because price skyrocketed. But that money's going to go right back out the door to buy the new house, right, at a higher cost for it. So you never know, because there's a lot of unforeseen circumstances that happen, which now is the inflation and the economy and interest rates rising very, very rapidly within a short period of time. That if you didn't plan for it, could be detrimental to you. So we talked about Terrence making a statement last time about it being your golden ticket to a happy life. But let's talk about the reverse of that. What if you start out, your early 20s, you get that credit card, right? And you maybe misuse that, right? What happens there, Terrence?
So with the effects of that, even if you misuse a credit card, that could go from usage, payments, how much you're paying. But if we're going to be general with the misusing a credit card, that is going to take pretty negative effect on your credit score. And what I feel some people don't really understand is what a negative effect on your credit score, it impacts everything else that you're going to try to do later down the road, especially when it comes to lending. So say you have somebody that comes in with a 680 credit score and somebody that comes in with the 800 credit score, and they both want to apply for a $30,000 personal loan. Chances are the person with that 800 credit score is going to get approved at a lower interest rate versus the person at a 680. One, because your credit worthiness is not where it should be for the bank to loan you $30,000 versus somebody that has shown that I can get this loan and pay it back with absolutely no issue. So of course that's where the credit score does come in, because the lower your credit score, the worse it is, the less the bank is willing to give you, of course.
And I think throughout the history of time, it has shown us that young folks don't think for the future, they think for the moment, right? And they're in the moment. This is not free money, right? A credit card is not free money. You have to pay this back. And if you don't, it's going to have long-term consequences for you that is going to affect that potential happiness, right? It's going to affect whether you can buy a home now that you want to have a family or do have a family. It's going to affect the cost that you pay for things, even to the fact of insurance, right? When you go to get insurance, they base the cost of that on credit as well. It's going to be more costly there. So, JJ, looks like you're going to chime in.
Yeah, I was going to say, because I want to add, there's even a bigger impact if it gets to the point that you didn't pay something off, where there's a collection or there's a lien. To Terrence's point, a low credit score, a lot of lenders, banks, we're moving into realms where we can work with that. Like you said, you were young, you made a mistake, but you've reestablished yourself. You've been paying rent for 2 years. We use all those factors. But if you get to a point where there's a collection or a lien, that's something that you had to pay back. Lenders don't like not being in first lien possession. That's a bigger impact.
Yep, and another thing with that goes along with is, like we talked about in the previous shows, even if you're incapable of paying off something completely, as long as you're still capable of making a payment, that is better than missing a payment completely.
Exactly, and that's a good recommendation for our clients out there is if you don't have the money for it, I'm not paying it, right?
Partial payment.
Call your lender.
No payment.
Call your lender. Call them and find out, talk to them, have a conversation. I can't make it, whatever the circumstances are. Can you work with me? A lot of times lenders are like, okay, well, I think they do this a lot of times within mortgages is they'll say, okay, we'll forgive next month or two or whatever. We'll throw it. They're not giving you that for free. They're going to throw it on to the end of the mortgage. Right? I can't remember what the term of that is. JJ, can you help me out there?
Look, now you don't maybe draw a blank, but
yeah, I've drawn a blank out as well too. But is it forbearance?
Deferred forbearance.
Forbearance.
Yeah.
Okay.
Yes.
Yeah.
Yes.
Forbearance was basically just saying, okay, for the next couple months to get you back up and caught.
Correct.
Right. We'll add these on to the end of the loan, basically extending it a little bit more for you. Now, do they count that as a missed payment on your credit or not? I think they do, but I'm not positive on that.
Yeah, and again, you're bringing me back to. I remember I was at the Urban League, and those things were big when people were missing payments. It goes back to the big collapse that we had,
2008.
Yeah, and that's everybody was doing those things. But I wanted to bring up that's a great point that you're talking about working with your lender. People think just because I'm borrowing money from them, they don't want to talk to them. They don't tell them. When it's completely opposite, you need to be talking to them because they can do things. They can change your payment date. There's all kind of different options that they're willing to work with you on. So,
because keep in mind, like I said earlier, the last thing the lender wants to do is come in and have to take your house, right?
Correct.
It's time, it's courts, it's attorneys, there's paper. That stuff is costly to a bank or lender to do that. It's not what they want to do. They're going to work with you first and hopefully get you back to a good spot to where you can now start making your regular payments on time and finishing out this loan, right? They don't want to have to come take that house from you. That's not what they're in it for.
Yeah. And I'll say too, based off what type of loan it is, I can tell you this. I mean, if it's a portfolio loan, something in-house, lenders and banks have different type of options and things that they're willing to work with you. If it's something through Freddie, there's different requirements and things that you have to go through.
Yeah, and that's one thing for our listeners out there. You probably don't want to worry too much about what Fannie and Freddie is. Rely on an expert like JJ to help you out with that because I've been doing this for a long time. I still don't understand all of that stuff. That's where the mortgage professionals come in on the Freddie and Fannie guidelines and what's going to have the better loan program for you when you go do it for it. But understanding that from the get-go, young people need to realize that their credit is important to them long-term wise, not in the moment, right? It's going to affect everything from you getting a house to here's a great example that I've heard, right? An auto loan, right? A lot of times we see those in financial hardship. They're having to use what little cash they have to buy a vehicle in cash because they can't get a loan because they've had credit issues, things like that. That's where, because of starting out with bad credit, it put them in a negative spiral. Where if you can get a loan, you're able to get a better car than you can afford in cash. It's going to last longer, hopefully less maintenance, less issues. Those buying it in cash, $2,000, $3,000, what kind of car is that going to get you today, right? You're probably going to need a new car next year. It's going to cost you more money, right? That's where those tax returns are coming in. Everybody's can't wait to get that to buy the new car. Had we kept our credit intact from the get-go and maintained good credit, we could rely on the bank to be able to provide that loan to get us a better car. So now it's not costing us our cash each year.
No,
right?
Not only that, but I mean, even if you're able to get maybe approved for a car loan, maybe you made some mistakes with your credit that, 8%, 7%, 6% car loan, because your credit's bad, it's now 20, 22, 25%. So that $300 a month payment for your car that you got approved for is now $600. So it's almost double because your interest rate's so bad. So that's still going to set you back. Even if you're able to obtain a loan, it's still going to set you back.
Yeah, you're going to have to go to special financing places because traditional banks aren't going to want to finance you based upon your credit history, right? Now you're jumping into that predatory,
Yeah, that's
that
exactly what I was
predatory
getting ready to
realm
hit
there
on.
where, hey, we'll give you a car, but you're going to pay us for that credit risk that we're
26%.
taking, right? Because we know there's a good chance we might have to come repossess this car and take it back, right? So for that risk, there's a cost involved with this. So understanding that as well, when you go to get something, it kind of seems unfair, right? Because the people that need the lower rates, that need it, are the ones that are getting the higher rates, but ultimately understanding and accepting that responsibility that we put ourselves in this situation, right? And learning from that experience. If you started out bad and instead of just, oh, I'm never going to pay this again. And here's a good one. Bank accounts. You gentlemen can probably appreciate that, right? A bank account doesn't affect your credit, but if you overdraw your account and you don't pay that money back and then it goes to being a charge-off, now that charge-off does start to affect your credit, right?
Sure.
Because it's now a charge-off, right?
Yeah, and I was going to say, can I give a public service announcement while we're talking about vehicles? You get that limit.
Shutting out somebody?
No, several. But hey, you get that limit that you just talked about, and you're on a payment plan. It's a limit. Hey, it's not working. You tell a dealer it's not working. They come and pick it up. You think, hey, it's resolved. Make sure you get it resolved. That's still on your credit report. You are still on the hook. You signed a contract. You still are on the hook to make those payments. So many young people get a scenario that you're talking about in that situation. They'll purchase that vehicle. It doesn't work. The people pick it up and they'll talk to them and say, yeah, I don't know why that's showing up. I didn't have that car. I
gave that back. They took that back, right?
Bingo. So yes, make sure it is resolved.
Yeah, and I think you gentlemen touched on that last episode too about staying in touch with your credit bureau and how to do that as well. You gave something back, make sure that was removed from the credit bureau or taken care of or showing resolved on there as well. A follow-up process for that to make sure that it was. Yeah. So with the little time we have left here today, anything else you gentlemen want to add when it comes to lending, banks, what they look for, the processes, anything like that you think would be valuable for our listeners?
I mean, just basically recapping off of some of the things that we covered, the things that stuck out the most, of course. Credit score determines interest rate, also determines on the loan amount that you're also going to receive as well, too. Other fundamentals would be try to avoid predatory lending if possible. And a partial payment is better than no payment. And if need to, talk to your lenders. They're willing to work with you.
Absolutely. Yep.
Yeah.
Jay, do you want anything specifically around the mortgage area? Let's talk about like prepping for a mortgage, right? When should somebody, how should they start the process, right? When should they come talk to you?
I mean, once you get yourself established, you have an income, you get your credit score to, it's funny how in tune people are with their credit scores nowadays. Even with that said, though, even if you get up 700, 800, we do have products where you're in the 650. I always say, come in and talk to somebody. Let us take a look at it and let us, decide whether your credit score is high enough or not good enough. But you're established. You can make your monthly payments based off of what you're making. Just come in and talk. Come in and talk to us.
So let me ask this question: should I come talk to you first, or start looking for a house first?
I'd say you know what, combination. Because I'll get people that come in, they have no idea how much house they can afford. So one of the questions I ask, have you been looking? So I guess it doesn't matter if you are out there looking. I'm gonna ask a question anyway. But if you come and talk, I guess come talk to me. We're gonna talk about the process. Simple formula that I use is however much your annual income is times that by 3. Kind of puts you in a general idea of what you can afford. And then, like I said, if you don't have any liens, any collections on there, that's probably the biggest thing as far as getting money lent to you. So
yeah, I think that's where my thought goes is if you bought a home before, you've been a homeowner, you probably know the process, so maybe you start looking for the house, whatever the case may be. But first-time home buyers who don't know the process, I think a great starting point is with the mortgage lender, right? So you can sit down, you can go over, you can help them understand what documentation they need, how long they've been at their job, right? You're typically probably not getting into a home if you just started a job last week, right? Job history, income wise, things like that. And then also, somebody like JJ will sit down and go over your credit with you and see, like, maybe we aren't in a position at this moment, but here are some things that you can do, right? So a year from now, you'll be in a better position for me to be able to gain that or get that loan for you for the house that you want, right?
Yeah, yeah. And I'll say, simple stuff, 2-year work history, a bit 2-year residency, whether it's renting or even living with somebody. Those are things to keep in mind. And I'll say this, and we've touched on this panel before, that relationship with that bank. You come in and talk to me. A lot of people have gone and talked to different banks, and they're kind of talking at them. They don't understand what PMI is or MIP. They're using acronyms and terms that people don't understand. But when we talk about relationships, come in. I'm that guy, and I know Terrence has talked about it, himself, that can explain some of the stuff. Even if you don't bank with us or, you don't use me as a mortgage lender, I'm going to help you go through that process and talk you through it. So
yeah, absolutely. And understanding everything that you're getting into, right? So if you have a mortgage banker that you're working with, and they're using acronyms like PMI and stuff like that, and they're not elaborating on what that means, ask the question. Because it matters, right? It matters greatly. You need to know what you're getting into when you're making the greatest investment of your life, which to most people is their home, right? Terrence, anything to add before we get out of here?
No, sir.
Nope. Chris?
I mean, I would just say, when you're looking at lending, relationships are huge with banks.
Absolutely.
That's a main focus. Is, if you have a good, strong relationship with us, maybe your credit score is on, teetering between approved, not approved. If you have a strong relationship, that's usually going to go a long way. I typically tell my people, handle your personal accounts exactly how you would handle your lending, because if you're overdrafting your account a lot, that's going to negatively affect what a bank can potentially do for you. Because if you're not handling your personal finances correctly, that bank then has an idea of, well, they're overdrafting their account. Are they going to make these payments for this loan? So
yeah,
a lot of those things matter that people just don't normally think about. Like, oh, I just overdraft my account. Why does that matter about me getting approved for a loan? Well, it does. Because, with the points that I just, presented. So
yeah. And as a PNC, do they offer all types of loans?
Yeah.
Like, are there
Yep.
auto loans, recreational vehicle loans, things like that?
Yeah, so
personal loans.
Yeah, we do auto lending, obviously home equity, lines of credit, mortgages, and then the personal unsecured loans.
Okay,
yep.
Good. The reason why I asked that question, because obviously one of my previous employers, which is one of the largest banks in the country, we were kind of limited on the products that we offered, right? We did mortgages, we did home equity line of credit for a time period, then they stopped during COVID. They do auto loans, but when you get into like recreational vehicle loans, personal loans, things like that, they didn't do those type of things. So they're just, sometimes it seemed to me like the larger the bank, a little bit more picky they were, right? They didn't want those riskier type loans, right? Because they didn't really need them on their books. So you may have a hard time finding that. I've noticed with smaller banks, credit unions, things like that, regional banks, that's when you're going to get into, full picture, full spectrum of the type of loans that they do, right? Yeah. So, but other than that, I think we had a great conversation today. Piggybacking off your guys' conversation a couple weeks ago in credit, leading into lending. Maybe we'll pick this back up in a few weeks as well. But next episode is going to be May 15th, and we actually have a special guest that's going to be joining us, Dr. Crystal Walker, who is a Senior VP of Human Resources at Sweetwater. I don't know if any of you gentlemen are familiar with her or not, but I had the pleasure of listening to her speak and her story at the Scan Gala a few weeks ago. And it really hit home with me, and I think for our target audience as well. She's going to come on and talk with us about, her background growing up in the 80s in, Inglewood, California, the economic circumstances she was born into, and how she chose to not accept that and change her life, grow into her current role. I'll let her tell her accolades and everything like that too. But it was a really powerful story when I heard her talk. And, the first thing I did was, reach out to her and say, I would love to have you on and talk with us about your story, because I think it'll be a powerful one. So she's scheduled to join us on May 15th at 8:30. So please join us then. Until then, our neutral voices, peace.